Hi again. Let's continue. Before I move on, actually, I should mention, well, there is a dilemma related to financial system, which is also connected to the what I call Minsky theory, but also there is another dilemma, which is kind of most basic and actually mostly when we are talking on the financial dilemma, this basic dilemma is um, talk on. Uh, Let me mention first that dilemma. Um, well, you might learn that in the introductory courses that interest rate, especially macroeconomics courses, interest rate, as I said, can be used as a tool to regulate the economic system. However, the same interest rate should also be used if your country is open to regulate amount of money coming from foreign countries to your country. So if your country is completely open, you have financial integration, and basically you allow monetary flow in and out from your country freely. In that case, the interest rate should be set at the level at which um, basically the price of your money, the exchange rate, remains stable. Otherwise, we have wild exchange rate fluctuations. Basically, and basically the international financial markets will fix your exchange rate and fix your interest rate, basically. Um, while if you do that, in that case, you cannot use the interest rate to regulate your economic system. I mean, in that case, financial tools to overcome crisis in your country are not anymore useful. So the being openness creates at the very beginning the dilemma for the countries what to do. Maybe restrict the financial integration a little bit and basically control the capital in and outflows. China does that, and create both financial stability and national financial policies. Or open your economy, but sacrifice, I mean, your ability to use financial tools to regulate the economy. Your country is big enough, like United States, you might still be able to use financial tools to regulate also your economy because the rest of the world will. The rest of the world, you can just your money is international money, which means you can print your money, and the rest of the world will demand your money. So you can keep your interest rate low, basically, um, uh, to keep your keep your economic system well more, let's say, healthy, or increase the growth rate in your country. That's also because I mean United States has the ability even when the interest rate is low in the United States, still countries borrow, lend their money to the United States because they trust to the United States. But this is pretty much the exception. I mean, for other countries, basically, uh, well, if they are open, if they are integrated financially, in that case, their ability to use interest rate for regulating their national economy will basically decrease. And the United States also doesn't care that much on the exchange rate because, I mean, that's actually the power of the United States. That they can buy anything they want in the world with dollar and with various prices in different parts of the world. Uh, so internationally, they borrow money from other countries with dollars, so they don't the money they pay don't change when the exchange rates change. So they don't that much concerned with the stability of the exchange rate. Let's go down. But there's actually one problem there. We will mention it when we come to the international financial markets. So let's come to the financial fragility. Here the idea is whenever economy is doing good, the basically good economic system means that the prices of the assets, I mean, for example, factories, the companies that are making more profit, will rise up. But when prices start to rise up, this will make financial investors start to invest speculatively. I mean, or let me say, they won't invest in companies taking into account the profit they make. They rather invest in companies just taking into account the price increase of the assets. So they see that the price of a company has the stock of a company, which is a share of the ownership of the company, has risen from, let's say, 5,000 to 6,000. They say, okay, if I buy it in 6,000 for $6,000, it will probably rise up to $7,000, and I will sell it when it becomes $7,000 and get a profit of well, 1/6 will be the profit. So increasingly, these type of when economy starts to doing good, increasingly this type of investors take place, and they especially take place in sectors which are doing excessively good. For example, if IT companies are doing good, then people rush to buy stocks of the IT companies. But in the end, this increase the price of the assets above the amount which is realistic. I mean, the interest rate will be the profit rates will be too low compared with the prices, because people don't care about the profit rate but just the price increase. At some point, however, the price increase might continue as long as you can find more buyers to buy this product, those stocks, considering the price increase. But at some point, the price increase will be price of those stocks will be too high, so you won't have any more buyers that are able to buy that stock, and basically even the price increase itself might be might be too slow compared with the existing prices. At that point, people will stop buying that stock. So that would by itself stabilize the price, but people were relying on the price increase to make profit. So when they're not able to do that, they start to sell the stock. Now, because people they rely on the price increase and price is actually decreasing, people start to panic. Everyone starts to sell the stock. So running out of potential investors, the companies which were actually doing good at the starting point might run out of investors, run out of money they can borrow for their new investments. So actually, this the whole financial system, the banks, the investors who have invested in those companies, those stocks in speculative way, they might face with all their investments go down, and actually the amount of money they have will reduce to very little amounts. Actually, they were experiencing a wealth growth which was at social level hypothetical. In individual level, you could sell your stock and get the money and buy things, but actually collectively, this increase in the stock market, the whole collective wealth of all stockholders could only be that high if they don't sell those stocks collectively, because they sell those stocks collectively. Basically, I mean, there is not enough. I mean, the GDP, as you see here, in extreme case, the whole production will be much smaller than the amount of money people will get if they sell the stocks they own. So when they sell their stocks, basically they will realize actually wealth was not as high as they think, but much lower. But probably at the time of this excessive borrowing, they have also made a lot of debt to each other. So basically, they won't be able to pay that debt. So the whole economy will collapse, and actual GDP will also fall, because people are not able to pay their debt to each other. They go bankrupt. Companies go bankrupt. So the financial system will take whole GDP down. Whether the speculative borrowers actually dominate, or whether financial systems are actually only run to crisis because of the external shocks, is a question by itself. But how fragile a financial system by itself when there is no regulation is another question. However, in the world economy, in national economies especially, financial systems were started to be regulated, especially after 1950s. But now at the global level, financial system, the financial resources, money usually flows to the places where the regulation is less, and as a result, in order to take that money back as a portfolio investment or the financial capital that back to their countries, all countries started to decrease those regulations to some extent. So now the question is, I mean, at national levels, this regulations might not be working, especially if you allow free flow of capital, financial capital, in and out of your country. If you don't allow it, in that case, just to be able to invest in your country, some financial capital might flow into your country and stay there. But if it can really go in when it is aiming to invest or pay a debt to a borrower in your country, or lend money to someone in your country, in that case, I mean, the whole financial capital itself will be held at locations where the regulations will be least, basically. So this is actually another interesting topic. I mean, this fragility of the financial system and the regulations that are aiming to control it. There are some other cycles, and those cycles and the whether or not they can be extended to the whole economic system is another question. There are investment consumption cycles. I mean, basically, when economy is doing good, people invest a lot. When they invest a lot, this investment itself will increase demand because there is more demand for investment goods. But when so the investment companies will also start to invest, which increase the investments even more. But at the end, those investments will be there will be massive amount of investments, but there are not sufficient amount of consumption that will basically make this investment pay off. So those over investments will make companies find out they are not able to find enough customers, and in the end, basically, this will go. Some of them go bankrupt. They will decrease the investments drastically. So the demand, some of them will fire workers because they have borrowed money and they can't find customers, and basically they are not able to pay that money. So when they go bankrupt, of course, the workers go bankrupt, or in order to cut costs, they might fire the workers. So in that case, the consumption demand might also go down. So whole economy will enter to the crisis. So this is proportionalness of the investment level and the consumption level, and how the disproportionate increase of investment and consumption in the economic system is another explanation, another type of cycle, which, according to some economists, creates periodically economic crisis. Another type of crisis can be created by technology. According to this idea, actually, whenever there are increasing radical innovations, the economy can maintain high profit rates, but when the innovations gets less radical, less common, in that case, profit rates goes down. So the main point is, after the successful radical innovation wave, the profit rates will go up, but this high profit rates will prevent companies or the investors to invest in more innovations. Why? Because when their profit rate is already high, investing in innovation is something risky. I mean, you don't know whether it will work. You don't know whether, if it works, the products you made with that new technology will find customers. So they won't take risks, and they won't invest. And what will happen after that? Let's discuss it in the coming part, which will be probably last part of this course, this topic.